In 2008, the world watched housing take down the global economy. 16 years later, governments are doing everything in their power to make sure house prices never fall again. This policy exists because your mortgage has become the most critical lever central banks use to control the entire economy. They need those numbers to stay high. State governments weaponized the concept of shelter, turning a basic human need into a tool for macroeconomic control. Buying a home in America before the 1930s was brutal. You needed half the purchase price in cash, upfront. Loans expired in 5 to 10 years. Unsurprisingly, most people rented for life. Then the Great Depression hit. Mass foreclosures triggered a chain reaction that threatened to pull the entire banking system into the ground. In February 1938, the federal government stepped in. They chartered an institution called Fannie Mae with a single desperate job: buy mortgages directly off the banks so those banks could keep lending. Paired with new federal mortgage insurance, this intervention created the 30-year fixed-rate loan. The modern housing market was born out of emergency triage. The moment the government started buying mortgages, housing debt transitioned from a private contract into a lever for state control. Once housing debt was standardized, it was easily packaged, securitized, and spread across the global financial system throughout the 1980s. This chart shows the macroeconomic mechanism policymakers discovered. If you lower interest rates, mortgages get cheaper. That forces monthly payments down. With lower payments, homeowners feel richer. They take that extra cash and spend more at stores, restaurants, and businesses, causing the broader economy to grow. Then the feedback loop kicks in. Home prices rise, allowing owners to borrow against their new equity, funneling even more cash right back into the consumer economy. Central banks integrated home affordability into their primary toolkit for steering the economy, utilizing this wealth effect to drive national consumption targets. By 2008, the math revealed a fatal flaw. Rising home prices expanded the economy perfectly, but falling prices actively destroyed the financial system. When prices slipped in 2007 and 2008, the cracks exposed that a massive portion of the banking sector sat precariously on top of mortgage debt. The response was sheer panic. Central banks slashed rates, bought mortgage debt directly, and handed out bailouts engineered to stop home prices from falling further. The intervention proved that the global economy had become structurally dependent on high home prices. Preserving these valuations became essential to the survival of the banking system itself. Since 2012, every policy tool deployed to stabilize the housing market has pushed prices in exactly one direction: straight up. This matrix outlines the 4 pillars propping up modern prices. Over a decade of near-zero interest rates, central banks buying up bonds, restrictive local zoning laws choking off supply, and institutional investors buying single-family homes at scale. This identical logic runs under markets globally. In the UK, the state propped up demand through help-to-buy schemes and massive Bank of England gilt purchases. In India, the story traces through strict RERA supply constraints and aggressive public sector undertaking bank lending. The tools change, but the upward pressure remains identical. The human cost is simple math. A new generation now requires a massive multiple of their parents' income to buy the exact same asset, entirely driven by these structural interventions. The global economy is now structurally bound to high valuations. Rising interest rates, or allowing a price correction, risks a cascade of failures across pension funds, banks, and household balance sheets, all of which are leveraged against these peak values. The global financial system has boxed itself in. It requires housing to keep rising, or enormous swaths of the economy will be wiped out. A modern home purchase is an entry into a mandated macroeconomic policy tool, placing the buyer at the center of the state's efforts to maintain economic growth. Once you understand this machine, you understand the core problem. The very leaders in charge of fixing housing affordability have the absolute least incentive to let prices fall.